Hi, Dan Ferris here, editor of Extreme Value, published by Stansberry Research. And today's video is inspired by, actually it's inspired by a fellow or guy or a gal on Twitter called Stock Cats, STOCKCATS on Twitter. And Stock Cats said, that he or she really liked a previous video I did called Read This Book Now or Lose a Ton of Money. And so I'm inspired to do part 2 of that. That video before was about a book called Bull by Maggie Mahar, and I said you should really read it right now because that book is about the boom from 1982 to 1999, and there are some parallels today. And so I think there's another book that is actually even better. It's the very best book on the history of financial speculation, and I have it right here. It's called Devil Take The Hindmost by Edward Chancellor. Devil Take The Hindmost by Edward Chancellor. Hands down the best, most readable, kind of deep, well-written, well-researched history of financial speculative bubbles. And I'll just tell you, he covers several events. Maggie Mahar's book covers just that one era. But and Chancellor's book came out in 1999. Just shortly before Mahar's book came out, but he deals with England in the 1690s, the South Sea scheme, like 1720-ish, emerging markets of the 1820s, the railway mania of 1845, the Gilded Age, 1929, and then he's got a section on cowboy capitalism from Bretton Woods to Michael Milken. That's a chapter, and he finishes up with the Japanese bubble economy of the 1980s. And then he's got the case of the rogue economist, just dealing with some of the individuals involved in some of these episodes. And of course, he's published in 1999, so he didn't quite include the episode that ended, the next year, really. But it's wonderful. It's a wonderful book. You can't be an investor, especially today in 2018, with stocks bumping up against their most expensive levels in history, U.S. stocks anyway, and many other assets. Lots of long duration assets are really expensive today. Stocks, bonds, real estate. Can't be an investor today in these things and not read Devil Take the Hindmost by Edward Chancellor. And I want you to do that. I've read it once and marked it up pretty good, and I'm probably going to wind up reading it 2 more times because I read a book a long time ago called How to Read a Book by Mortimer Adler, and he talked about why you should read things 3 times. You get the sweep of it the first time, you dig in the second time, do lots of underlining and thinking and maybe some research and things. Then you go through the third time and kind of put it all together. And that's what this book deserves, that kind of a treatment. Not certainly very few books do, right? So just take a taste of this. There are, for example, I found one passage that you'll get a kick out of. It talks about the proponents of new era thinking in the 1920s. Everybody said it was a new era. Nobody knew the stock, people didn't think the stock market would crash. Most people didn't. And so we all know about the economist Irving Fisher, who said it was a new era, and he said something like, he said, modern production is managed by the captains of industry. These men are specially fitted at once to forecast and to mold the future within the realms in which they operate. The industries of transportation and manufactures particularly are under the lead of an educated and trained speculative class. May be true, but it doesn't mean that they weren't going to screw the pooch and crash the whole thing, right? And it didn't mean that they were omnipotent or omniscient or anything of the kind. But it didn't mean that they weren't misallocating capital like crazy when it was, widely available. So then a little farther down, same page, page 193, Fisher was not the only proponent of the new era. I got a huge kick out of this one. I hope you do too. In 1927, John Moody, founder of the credit ratings agency, declared that no one can examine the panorama of business and finance in America during the past half dozen years without realizing that we are living in a new era. In April of that year, Barron's envisaged a new era without depressions. But I put a note in the side here, and it says, Moody's has always been wrong! Exclamation point. Of course, Moody's really screwed the pooch in the housing bubble because they declared that all this garbage that was really full of crappy mortgages was magically AAA rated, right? And so from the very beginnings, Moody's has been this, you know, highly pro-cyclical, nearly totally worthless crap business that people say it's a financial utility. And I don't disagree with investors like John Ubben who invested in it on that basis, because he's basically investing based on what other people think. And I get that. But Moody's is not a financial utility. It's a hunk of crap. They don't know what they're doing, obviously. And it's highly pro-cyclical. You know, whatever's going on is great with them. You know, if everything's wonderful, everything's wonderful. If everything's terrible, everything's terrible. So you'd never invest based on anything Moody's says. You kind of want to do the opposite at the extremes of valuation. And you know, I just have other notes. That, you know, there were Fed-born optimism I put in the margin of this one page, and there was a talk of the endurance of the Coolidge prosperity, and I said just like Trump in the margins. So just those two pages, 192 and 193, give you the sense. And I got another note up here actually. It says Tesla, the automated car production lines of Detroit, known in managerial techno-speak of the day as Fordism. And there's a whole thing about that. That's the end of the sentence. But then I've just put Tesla in parentheses. So there are a lot of parallels, I think, that are worth kind of thinking about. Of course, there was a famous, just paging through here, there was a famous article at the time in Ladies' Home Journal that was called Everybody Ought to Be Rich. And there was actually a guy named Lawrence Edgar Smith, that's in this book too, Lawrence Edgar Smith, who wrote a book about common stocks for the long term, I think was the title of it. And that guy and another guy, they wrote these two books, and then, of course, it led to Raskop's article, Everybody Ought to Be Rich. And so this idea that everyone should invest in the stock market, that regular people can get rich by investing in the stock market, became more popular. Didn't become as ultra popular as people think. I mean, the country, I think, had like over 100 million people, well over 100 million people. But, you know, I think maybe 9 million accounts were on Wall Street at the time. So it wasn't like everybody's doing it, but enough people were doing it. And enough people were absolutely insane about the way they were doing it. And it's sort of like things now. Nobody thinks, you know, nobody thought that RCA was a bad bet in the 1920s. Nobody thought Cisco was a bad bet in 1999. In fact, in part one of this video, you know, read this book or lose a ton of money, I pointed out that Cisco was like the most popular stock in the 10 biggest mutual funds at the time. And GE was one of the most popular stocks. I think it was in 9 of them. Cisco was in 10 of them. So, and Cisco hasn't broken even. If you bought it at the top in 99 or 2000, whenever the top was for it, you're still yet to break even. It was the no-brainer. It was the safe one. And that's what happens. It happened in the housing bubble. Everybody thought, well, housing is safe, mortgages are safe, I'm fine there, I can just dump as much money as I want in there. And today, well, you know, Google, Amazon, Facebook's safe, I can dump as much money as I want in there. Yeah, what's happening now? You know, people lack imagination. They lack the imagination to think, oh, maybe, you know, buying things that, you know, I mean, Amazon must be trading at 50 or 60 times all the profit it's ever made at this point. And you know, Facebook is trading at some exorbitant multiple. They all are. Nvidia must be 15 or 20 times sales by now. And of course, I don't have to know the numbers because I know they're all absurd, whatever they are. And that's exactly what happened, you know, the last time in the tech bubble and in all previous bubbles. You know, the Nifty 50, right? Xerox, Polaroid, Avon, no-brainers, right? It's easy. You can do great putting money into them. Nothing's ever going to happen there, and they lost 80 and 90% of their value. That's what happens. That's what happens in these episodes, and that's why you need to read this, because you need to remind yourself that people thought all these no-brainer bets were just the safest thing in the world, and they got destroyed making them. I mean, you've only broken even on Microsoft if you bought it at the top in the 90s within the past year or two. And you still haven't broken, well, poor GE, of course, you haven't broken even on that one. And I think AT&T you haven't broken even on yet. And there are probably a number of other ones. And of course, you got completely destroyed on some other things. Um, you need to read this book. It will remind you, and it'll do it in a fun way. It's very well written, deeply researched, and I think I'm just going to leave it there. Okay, if you don't remind yourself what this feels like, you can look at the charts all you want to, and do that. Look at a price to sales chart of the S&P 500 as far back as you can get it. This is as expensive as it's ever been by that measure. At least back to as far as I can find on Bloomberg. And there are other measures. If you go to HussmanFunds.com, John Hussman tracks 5 of those measures for the S&P 500, and they're bumping up against their all-time most expensive levels. So, think about that by all means, but read stories and remind yourself, get a sense of the history, read Bull, read this, and remind yourself what it feels like to be in a huge equity bubble and how it just feels wonderful and everybody thinks it's okay. All right? That's my message for today. I highly recommend this book, Devil Take The Hindmost by Edward Chancellor. I think it can really help your thinking if you're invested in all these expensive long duration assets, stocks, bonds, real estate, etc. Okay, enjoy the book and talk to you soon.